Hello and welcome, sorry about that, to Martyn Lucas Investor. My name is Sensei and you're watching the special coverage of the FOMC of the UK. So we are having rate decision is in 4 minutes and 50 seconds. Then we have the speech. The reason we're covering it is because a lot of UK people, this is important to them. Mortgages, it's the same as the US, but important here. But also for global markets, it will have an effect because people will look at this to see what's going to come in December with Jerome Powell and the Fed there in the US, which affects the global markets a bit more. But this is very important. We're covering it 4 minutes time until the rate decision. Thank you everyone for tuning in. We've also got Rachel Reeves coming out this month with our budget. Everyone around the world will be looking at this budget. But especially here in the UK. So we're going to be covering that budget as well here in on Martyn Lucas Investor. But right now we are covering, we had some amazing news about Ripple yesterday, $40 billion valuation, but we are covering the Bank of England. So where is it? Let me bring it up. There we go. The Bank of England rate cut decision and the autumn budget collide. Firstly, there is a repost. Please go and repost this, and it's an entry in to win $2,000 worth of XRP. The link is in the live chat right now. So you can click on that. Let me give you the exact link of the tweet. Here it is. Just go repost and hit the like button on it. If you go and repost this, I've already done it. You can do it as well, even though I can't win. I still do it. Click that link and that'll take you over to Martyn's X. And please hit that like button and repost, and then you can claim your tickets on the giveaway page. If you have just tuned in, my name is Sensei. We go live every day 2 hours before the opening bell, but we've been live a little bit earlier today. Lots going on that we wanted to cover, and also the rate decision is here in 3 minutes time. Please do share this out. Please do hit the like button. This is not when we're not normally live, so it matters more if you hit the like button now so it can get pushed out to our audience. So it takes 1 second and we do appreciate it. Hit that like button. So we're bringing you special coverage of the rate decision. It does look like it's going to be a pause, but the speech will come up. So the speech will be half an hour later. So we're going to watch that as well. And then we'll analyze that so we can get ready for the FOMC there in the US. So let me just check all of this. Yeah, okay, so the Bank of England rate decision and autumn budget collide. The Bank of England is expected to hold interest rates at 4% when it announces its decision at 12 p.m. GMT, but the vote could be its worst in years. Markets consensus leans towards a 6-3 hold, though some analysts see a 5-4 split, reflecting rising pressures for a 25 basis point rate cut amidst slowing inflation and and weaker labor data. Literally the same situation as in the US. You can you could just say the US and you'll think we're talking about the US. Headline inflation eased to 3.8% in September. Wage growth is trending below 4% and unemployment has inched up. Data that led Goldman Sachs to forecast a surprise cut this week. Markets now assign roughly a 1 in 3 chance of an immediate cut, up sharply from 10% a week ago. Are we going to get that surprise rate cut? We will have a look. Policymakers are now constrained by fiscal timing. Chancellor Rachel Reeves' autumn budget due November the 26th. We'll be covering that live on the channel as well. That'll be a bad event, I'm sure, because of what's going to the tax rises. Is expected to tighten fiscal policy by as much as 30 to 35 billion, largely through tax rises on capital and property. Let me just see if I can get this up as well, just to make sure we are covering everything live. Let me just get that decision. I don't think is Bloomberg live yet. Yeah, they are, but I don't think they'll be covering this. Okay, so they'll be covering. I've got the Bloomberg stream when they've got an exclusive event for this Bank of England rate decision. I'm just seeing if they'll cover the actual rate decision, which is in 30 seconds time. Oh god, there's so many tabs open. So yeah. Are we going to get a surprise rate cut? The forecast says no, but Goldman Sachs says yes. If we do get a rate cut, that will be a major surprise. I'm going to go over to Bloomberg as well. I'm sure they will have special coverage of this. Let's have a look. Okay, any second now, we're going to go over to our economic calendar. It's refreshing as we speak. Let's see what we have. Let me put Bloomberg here as well in case they do decide to cover it. It's refreshing any second now. Is it going to be a rate cut or is it going to be a hold? Consensus says not a rate cut, but if it's a rate cut, it'll be massive. Oh, 4-5. Oh, that was closer than expected. That was very close. 4 people voted on not a rate cut. 4 people voted against, 4 people voted for a rate cut and 5 people voted against the rate cut. That was very close. 1 vote away from having a rate cut there. So a decision is we're staying steady. What is this, Premier Live? Ricardo, we are live right now. This is happening as we speak right now. Okay, let me change the timer because what we're going to have now is even more important than this, because this is going to be a very exciting speech because it was closer than anyone would have expected. Let me go over here. Apart from Goldman Sachs, of course, they actually expected a rate cut. But everyone else did not expect it to be like this. So let me put in this countdown because now we're going to get the live speech. So this is the speech. This is essentially Jerome Powell speaking in the UK. So if you haven't watched this before, let's see how different the tones are. Special coverage will be starting here as well from Bloomberg very shortly. If you have just tuned in, we're not live at our normal time, so please do us a favor and hit that like button and get this out to the audience so that everyone can join us and not miss out on the show. Subscribe if you haven't done so already. Is this a premiere or live? Ricardo, this is live. 153 people, only 15 likes. Yes, what's going on? Why is it? I know it's early for most of you, but hit the like button. Good morning, says everyone. Okay, let me see how. So yeah, we've got the report out as well. Bank of England minutes. Let's see the report. Not over here. Still loading. Here we go. Yeah, the breaking news. They leave it unchanged at. That can't be right. No, this is that can't be right. 5.25%. That's not right. That's from 2023. So yeah, we don't have the report yet, but we will have the report in a 10 minutes time. Special coverage starts in about 11 minutes time. So if you have just tuned in, we're covering the Bank of England decision right now. It was supposed to be a hold. It was 1 vote away from being a cut. It was very close from being a cut. It's very interesting here in the UK. You can see when it comes out, you can see how many people voted for. I mean, it's the same in the US, but economic calendar shows you right away that it was 5 people voted to keep it unchanged. 4 people voted for it to be a rate cut. 0 people voted for a rate cut. The consensus was 6 people unchanged and 3 people voting on rate cut. So more bullish than expected, but we didn't get there quite enough. So no rate cut, but I think the reason is because of Rachel Reeves. If you haven't heard about Rachel Reeves, she is our, what's her name? She's our, does all our budgets. What's it called? I've forgotten. Rachel Reeves is our, it should be in the newsletter. Rachel Reeves is our Chancellor of the Exchequer. She deals with all our money and physical policies and taxes. And with the Labour government right now, all she's done is raise taxes, pretending that it's not on working people, but she puts it on the businesses, and the businesses have started to lay people off and they can't survive. So, effectively, we're going to have another budget. It was supposed to be no tax rises when they came into Parliament. They had their tax rises. They said that's going to be a once in a lifetime because there was a black hole that they made up. Essentially, just made up some figures and then borrowed money by making up more figures. And they said, okay, we're never going to do tax rises again. I promise. And now they're being very silent. On the 24th, Rachel Reeves is going to come out and probably give us some more tax rises. So happy days here in the United Kingdom. So let's see what happens. 24th of November is our budget. That's twice a year. This is where they announce the next sort of policy decisions in terms of taxes, etc., and how much money they're going to be spending. And I think they didn't want to cut the rates because of the uncertainty that will come with that. So UK inflation has now accelerated to 3.8%, edging towards 4%. Chancellor, oh, thanks, guys, for reminding me. Stay with us. The speech is in 25 minutes. If you have just tuned in, hit that like button and subscribe. Let me have a look at this. Um, let me just reply to this for 1 second. 24 minutes. I apologize that we are live earlier, but we wanted to cover that decision. We just also did put out a XRP analysis that will come out later as a video because I know a lot of you missed that. Let me just reply here. So what was I? Yeah, Rachel Reeves is coming up for budget 26th of November. If you guys want to see some fun and you want to see the UK Parliament and you want to see a speech inside the UK Parliament, I know some people in the US like watching our Parliament. Watch on the 26th of November, 26th, 24th, something like that. Here on the channel, we'll be covering the whole budget, and we'll be in the Houses of Commons where that budget is released, and I'm sure there'll be a lot of screaming and shouting. So tune in for us, and then you can see the UK's extra tax rises, the US tax cuts, UK tax rises. The Bank of England noted that the government policy has added 0.6% percentage points to inflation. They are directly contributing to inflation, with energy, water, and vehicle taxes masking earlier disinflation. Food inflation climbed to 4.3%, projected to hit 5.7% by December, before easing in 2026. Analysts warn that Reeves' own fiscal levers, taxes and wage policy, may have tightened the cost of living squeeze she is now trying to fix, particularly for lower income households whose essential costs are outpacing essential costs outpace earnings. Reeves is expected to focus on energy and food, which dominated household budgets. Options include removing the 5% VAT on energy bills at the cost of 2.5 billion annually, or cutting environmental levies that make up 16% of electricity and 6% of gas bills. So yeah, this is I think why we didn't get the rate cuts, because that budget is coming. So this is the Bank of England we're watching here with their decision right now. Remember, if you are from the US and you think this has nothing to do with me, well, it does have a global effect, definitely not as much to the US. However, what we can try and do as investors and people that look at the markets every day is see what they say in this speech, and you can essentially see what the US are going to do, because they are in very similar situations in terms of inflation, because the US has extra inflation because of tariffs. The UK has extra inflation because of the recent budget. So that kind of evens out. So they're both on the same inflation path. They haven't cut rates. So does that mean in December we won't get a rate cut in the US? Maybe. But more importantly, what are they going to say during the speech? Sorry, we've got some sort of troll in the chat. Fake news and fake videos, right? Yep, everything's fake here, Anna. What are you on about? Oh my god, fake news and fake videos, right? Please don't put stupid allegations out there when it's just everyone knows. I mean, it's just stupid. At least try and say something that that's believable. Try and say, I don't know, say that my beard looks funny. I don't know. Don't say stupid things like fake videos and fake. That's like the opposite of what this channel is about. This channel is all about honesty and being live. I mean, we're live right now. The speech is in 21 minutes. What's fake about what we're doing? Here we go. I think the special coverage is starting any second now. Oh, 6 minutes until the Bank of England rate decision special. I've got quite a few tabs open, so let me close some of these because of yesterday's stream. Okay. 20 minutes away. Let's go over to the chat. Thank you everyone for tuning in. Yes, it's a bit early, but the speech is starting in 20 minutes. Special coverage starting in about 5. We are here to help. We're not sponsored by anyone. Plus, always live. This is not even a video. We are live with you and fully accountable. Yeah, we are. I mean, we're here. If you got confused, it's fine. Let us know. We're here. We're here to help. Move the product says XRP to the moon. Thank you for being here. Nada says hello, Rachel. Come out, wherever you are. William Bond says good morning. Stephen is here. Morning to all. Hello, Stephen. Matty says good morning again. Oh, guys, if you have just tuned in and you want to win extra tickets to for the competition, if you, there's two. One is from the video we've just put out. I put it out as a video. It was a live stream, but I put it out as a video. So you keep an eye out later today because you'll get some magic numbers from that video, or you can go back and watch the previous live. Secondly, something you can do right now very easily is go repost this. I've just spammed it in the chat. I'm spamming it. You cannot miss it. Click that in the chat and just go repost it, and you can claim your tickets on the competition page. Repost it for a chance to win $2,000 in XRP. We are now waiting for the speech to start. There we go. Okay. Whacker troll says Robbie C. Yeah. Oh, it's also pinned as well. Brilliant. It's pinned to the top. There's a repost to win tickets. Yeah. Okay. Hi all. Hello, Brian. We're waiting for the Bank of England. We've just spoken about how much we love Rachel Reeves. If you missed yesterday, big announcement about $40 billion valuation on Ripple with their latest round. Robinhood smashes Q3 earnings, but crypto miss, and a CFO exit temper the rally. So what is Robinhood doing right now? Remember, we've just been covering Ripple swell. We've been out of the market. We haven't really been covering the markets for a while. So Robinhood. What am I doing? Hood. How did it do with earnings? Up 4% yesterday, and now pre-market it's flat. It's flat on their pre-market. Okay. We're getting ready for the speech coming out. Let's go to Bloomberg for a second.
There are still a lot of inflationary catalysts.
We're not creeps up a little bit with an underperformance of some of the AI-related names as other companies do better. And that's kind of what you've seen underneath the hood of markets. When we saw a sell-off earlier this week, it was actually one with broader participation and more gainers than losers. So it really raises a question. Is that what we're expecting next year? And is that kind of the recovery that is deeply unsatisfying for some?
The stock market doing okay this morning, positive by close to 0.2% on the S&P 500. With an update on stories worldwide, here's your Bloomberg brief with Yahara Arnott. Hey, Yahara.
Hi, John. The Bank of England holding its key interest rate steady despite 4 members pushing for an immediate cut. The central bank signaled a gradual downward path for future rates, noting that inflation risks are now more balanced. The BOE also lowered inflation forecast, expecting it to fall below the 2% target.
This is what we're going to be covering later. Rate decision was a hold. We're now going to get, Snapchat up 20%. That was looking very good when I looked at the chart a few days ago. Snapchat up 20%. They must have had their earnings. So yeah, Bank of England holding rates where they are. 4 people actually wanted a rate cut. 5 people said hold. So they're 1 vote away from getting that rate cut. Cutting inflation expectations. Moderna up 5% as well. So we're going to be covering the speech in 17 minutes. It's going to have an effect. We're going to have an insight on what will happen in the US. This is sort of, imagine this as seeing the future. The speech we're going to see now might be the speech that we're going to hear in December from Jerome Powell at the next FOMC.
Our sole role is to make sure that we keep this airspace as safe as possible. There is going to be a 10% reduction in capacity at 40 of our locations.
Up next, John Lieber of Eurasia Group, live from New York.
Shutdown continuing. We had a story in our newsletter about that, I'm pretty sure. Yeah, look at this. The FAA orders 10%. I'll go through so many news stories every morning, and I don't know which ones I think are the most important to pick out. So I knew I saw the story. I just didn't know if it made the cut, but it certainly did make the cut. FAA orders 10% flight capacity cut amidst historic shutdown. So there is a 10% reduction. The Federal Aviation Administration will reduce U.S. flight capacity by 10% at 40 major airports starting Friday. It's in an unprecedented move to preserve air safety as the government shutdown enters the 36th day, the longest in US history. The phase cuts 4% on Friday, 5% Saturday, 10% next week, targets domestic routes through major hubs such as Atlanta, New York, Chicago, Dallas, Fort Worth, potentially grounding 1,800 daily flights and removing 2 168,000 seats from circulation. Transport Secretary Sean Duffy said the data will detect what we will do, hinting that further restrictions could follow if conditions worsen. The FAA Administrator Brian Bedford confirmed that this is the first proactive system-wide capacity reduction in the agency's history, describing the decision as a controlled slowdown to avoid catastrophe. Okay, so let me welcome everyone into the show. If you have just tuned in, please do hit the like button. Please do subscribe. We're just covering the rate decision, which is a pause, and the speech is starting in 14 minutes time. So this is going to, remember, the speech is more important than the decision itself. If you have just tuned in, hit that like button because we are live a bit earlier than normal. Don't want anyone to miss out. What do I think about Epic Chain? I don't look at it. I've never heard of it. That's a question in the chat. Nvidia's stock price prediction will be, I mean, we've given all our predictions. I mean, look at some of these predictions we've given this year. Oh my God. Nvidia was perfect as well. NVDA. If we just zoom out and I'll tell you exactly what's happened this year with Nvidia and what we've been saying. $100, $100. We had our, this is this year. Of course, we've been in Nvidia longer than that, but let's say just from this year. We talked about this being a double top at $150, and we said $100. Keep an eye on $100, $97, $97. We are going to come there, and that could be support, and there was an upwards trend. And we caught that exactly. Went down to $97, went down to $90 out trend line. So we got our buys at 100, our buys at 90, and then we said, okay, we break $150, which is the next move up. We expect the main target to be at $195. Where did we go to? We have now hit $195. So the main trade of this year, I mean, how high is Nvidia going to go? Probably higher over time, but it's not looking like an amazing risk to reward to me right now. We did 120% in a year on a stock that was already pumping. So very happy about that. I think Martyn's target was $200. We were both very bullish at $99. Technical charts, the fundamentals. I do have one final target of $233, but the main target was $195, $200. So congratulations to you. If you want another target, then I'll be looking at $233. But I'm not, that risk to reward for me is not brilliant unless I'm holding long term. I'll be looking to buy Nvidia in a bear market or in a recession. And if I don't get it, I don't care because I've got other investments. So that's my thoughts on that. Again, not financial advice. Let's go over to the special coverage because that will be starting any second now. This is the Bank of England. Do this. I'll keep this open up here so I know when it starts. We can go back to our coverage over here.
We are not seeing a change in the equation when it comes to the negotiations between Republicans and Democrats here in Washington. After Tuesday's election victories for Democrats, we saw the party's top two leaders in Congress, Hakeem Jeffries and Chuck Schumer, write to President Donald Trump asking for a meeting with other congressional leaders to try to negotiate a way out of it. But President Donald Trump so far has not taken them up on that offer. And instead, he is urging Senate Republicans to do away with the filibuster rule. And that would allow the party to jam through on party lines the spending package that has been held up by Democratic objections over potential losses in health benefits. That's really at the center here and what Democrats want to negotiate. But we're going to have to see, John, how much further this can go and how much more pain the economy will have to take before leaders on both sides start to move. And we'll see who blinks first here.
Hey, Shep, appreciate the update and the framing down in Washington, D.C. Tracking the White House and the president, Lisa, doesn't appear that this is on top of the priority list for them this week. The major one in the last week has been the last 24 hours of the Supreme Court.
There's been more commentary about that. Yes, we are hearing about ratcheting up the pressure, and I'm looking, and if you're leaving any major airport,
Time to go over to our special coverage, well, Bloomberg special coverage, but we're also covering it of Bank of England.
Steady. They see 15 basis points of cuts in December. Now, in terms of analysis, we've got a fantastic team lined up for you around the desk here. We've got our go-to bond guru, Bloomberg opinion columnist Marcus Ashworth, and our long-time BOE watcher, Lucy Meakin, managing editor of our Daybreak newsletter. Welcome to you both. Marcus, let me start with you. Was this the right decision to hold rates, given we've got a budget coming up?
Yes, because it puts the pressure rightly square on Reeves, and she has got to deliver a budget which is both not too growth destructive, otherwise sterling will collapse and create certain problems, but more importantly, not inflationary. unlike her one last year, which caused all sorts of problems and got right in the Bank of England's way. The Bank of England is saying, please get out of our way. And if she does deliver a budget which isn't inflationary, then I think they'll almost certainly cut. I think Bailey could have cut, and it was his decision not to. The fact that Breeden, who's been closely linked to Bailey's thought process,
who needs these analysts? We said exactly that. They're not cutting because of Rachel Reeves. Hopefully Rachel Reeves comes out about inflationary budget on the 24th. If you want to watch that, we're covering it live on the show. And then they will cut rates. There is, if you look at the pinned comment in the comment section, in the live chat, you can win $2,000 of XRP if you go and repost that.
it will take this much more positively, and we'll start to perhaps eradicate that spread we have over all other government bond yields around the world.
So you think Andrew Bailey's dangling a carrot at Rachel
big
Reeves
time.
here?
Yeah, and do you know what? Good for him. I mean, I don't want to get too into political, interference or independence of central banks, but this is really a symbiosis between Reeves and Bailey. If they can get it right together, if she can do what he needs to, and then I think we have a virtual, away from the doom loop, potentially something towards a virtuous circle.
Go on, Lucy, let me bring you in here. Were you surprised by the vote split? It's tighter than most economists thought it would be.
Yeah, I did not see this one coming. I was fully prepared for Sarah Breeden to go across. Swati Dhingra, Alan Taylor, yes, cuts. We saw that one. Sarah Breeden, I did not see. Dave Ramsden, I did see. But as Marcus says, Sarah Breeden is so closely aligned with Bailey. It's the first time that she's gone in the opposite direction to him. So this is really quite a big signal. And we were all watching Bailey because he's always been the swing voter that we've been looking at. Maybe he's, given her a little nudge to go that way.
Yeah, it's interesting that the internal members of the Monetary Policy Committee are dissenting, now Sarah Breeden as well. I want to bring in a former member of the Monetary Policy Committee now, and that's Michael Saunders.
We have the Monetary Policy Committee here in the UK.
At Oxford Economics.
They are basically like the Fed,
as always,
and they vote on rate cuts or not.
How would you have voted if you were on the MPC today?
I would have voted for no change in rates. I think the temptation is very strong to wait to see the budget. Also, more information on CPI inflation and, crucially, more clarity on where pay deals are likely to settle for the next year. They'll know more about this in December and February, and I would expect them to cut rates at one of those two meetings.
OK, so do you not think that inflation's peaked at 3.8%?
Yes, I think it probably has. But the issue of the MPC is not whether inflation's going to fall, it's whether it's on a track to get back to the...
Guys, this is directly correlating with the US. We're talking about inflation peaking. The US, Jerome Powell says inflation's peaked. Remember the secondary peak, by the way. And the UK are saying that inflation has peaked. So they're both going off that assumption. So this is sort of like watching the December Jerome Powell, but today.
The 2% target. The MPC are worried about an outlook in which pay growth is a little sticky and inflation would be likely to settle at 2.5 to 3 rather than go all the way back to the 2% target. So that would still be lower inflation than we have now, but not good enough from the MPC's point of view.
And where do you think neutral is? Because, of course, we don't know, but most economists reckon 3%. Is that about in line with your view?
So you could work out plausible estimates of neutral, which are anywhere
same in the US. They're saying around 3, 3.5,
3 3/4. Personally, I would go for around 3 1/4. But you got to acknowledge the uncertainty around that. And part of the reason why the MPC are being more cautious about cutting, skipping the regularly quarterly cut cycle that they've had for the last year and a bit, is because rates are closer to neutral, right? So it's less obvious that the future path for rates is downwards. And they've made the forward guidance such as it is. The rates are likely to fall further, provided there's further progress on disinflation. It's much more conditional forward guidance. It depends on inflation behaving as they would like it to.
Well, yeah, I characterise this as a dovish hold, taking liberties perhaps, Michael, but that is how the market seems to have read this. Is that how you see this, a dovish hold?
I think that's fair. They're trying to ensure that while rates are on hold now, the markets still see the scope for interest rates to come down further if the budget, the inflation data, and pay deals come out the right way. Compared to your discussion before about them just waiting for the budget, I would broaden it slightly and say that it's going to be the next few inflation figures and what they get back from the Bank of England's agent survey on pay deals that will be also important in their decision making.
OK, really interesting. We've just had the reaction from the Chancellor herself, Rachel Reeves, welcoming the cut to the inflation forecast, which, of course, they've just made. This is a new set of forecasts accompanying the decision. I wonder, Michael, did it give you pause in her speech on Tuesday when the Chancellor ventured to comment that 4% interest rates are constraining business borrowing? Some have said that that's a bit Trump-esque.
I don't know. I think that the Bank of England has said that they think 4% is a bit above neutral, so it's fair to imply that that's restraining demand. Obviously, it would affect both consumer spending and business investment. I don't read that as putting any pressure on the Bank of England. I think it does acknowledge that if inflation and fiscal policy do the right thing, then there should be scope for interest rates to come down further. Reeves will play her part in that through a tight budget. And that would be one of the things that should help the Bank of England to cut interest rates in the next couple of meetings.
Well, do you really believe that? She's just now repeated that pledge to cut inflation after this hold from the BOE. She made it on Tuesday, saying that the budget is going to be disinflationary. I wonder how she could do that and how the committee will have factored that pledge into their thinking today.
So the MPC won't have factored in what the budget might do. They will take the budget into account once the budget has been announced. That'll be for the December meeting. In terms of how the budget could affect inflation, you've got to distinguish between two slightly different things. One is the budget might have a direct effect on near-term inflation. For example, if the Chancellor cuts VAT on energy, as has been mooted, that would reduce inflation in the coming year directly. But it would only be a temporary effect. It wouldn't last beyond 1 year. Effect on MPC policy, probably pretty small. If the Chancellor tightens fiscal policy overall, raises taxes, cuts spending, that would dampen growth in the economy, and that would have a much more durable, persistent downward effect on inflation. And that's the kind of thing that could prompt the MPC, would allow the MPC to cut interest rates further.
Did the timing of her speech on Tuesday make you wonder whether it was targeted at the BOE, coming just right before a decision?
No, not at all, right? So the idea that the government are trying to influence the Bank of England, like directly asking them to lower interest rates, or that the MPC would listen to any such request, forget about it. The MPC take into account fiscal policy because, of course, it shapes the economic outlook. But it's only really through that channel. They're not subject to political interference in any way.
Just coming back to that vote split, Michael, something you and I have discussed lots of times is how it's used or not used as a tool of communications. Do you think that the BOE, and particularly the governor, were trying to send out a message here when you've got Sarah Breeden, a deputy, an internal member of the committee, dissenting?
No, I don't. The MPC members are individually accountable for their views. So Sarah Breeden
has a poll in the chat,
not to try to send a message,
but
because that's what she believes is the appropriate interest rate. I think when they try to send a message, they do so through the monetary policy summary and the forward guidance, which there is. And that, I would think, indicates that interest rates are likely to fall further, provided inflation and the lead guides to inflation, such as pay growth, and also things which affect demand, like the budget, as long as those go the right way, then interest rates will come down further. So they sort of don't need to send a message by manipulating the votes. They have plenty of ability to send a message through their language, and they've chosen to do that.
And indeed, we've got plenty more language to...
I don't fully believe, but what a wonderful world if it was really quite so innocent and independent of any form of influence, either from the government or to the Bank of England. But there we go. That's a diplomatic way of approaching it. Look, I think the markets are going to read straight through this, and I appreciate Michael Saunders' view. I just don't think the market is anywhere so innocent as to look at it that way. I think everyone is expecting a rate cut. Quite clearly the body language from Rachel Reeves is she's worked it out finally what she needs to do, and I think we will see probably continued gilt out performance. They've got a long way to get back, and I think there's plenty more room for gilt yields to fall. We'll obviously see what Bailey has to say. He'll countenance everything as ever very carefully, eschewing any form of influence or or that sort of stuff. But I don't think the market's got any time to believe that.
Yeah, Lucy, you've been to loads of these press conferences before. What would you be asking the governor today?
Well, what I would want to ask is what Rachel Reeves could do to derail a December rate cut now. Yeah. What could she do in this budget to make it go wrong? Oh, yeah. That said, I would not expect him to answer it, so it'd be a wasted question. I probably wouldn't waste my breath.
And you were talking about the optimistic view there when it comes to credibility, Marcus. If they'd cut today, would we be asking questions about the BOE's credibility?
Yes, we would, and I think they probably Bailey actively took the right decision and had to take the right decision. But I think Lucy was right to infer perhaps that Breeden moving across gives enough signals to everyone that needs to know that you know, all things being equal, if Reeves does.
Let's get ready for the speech. This is the equivalent of Jerome Powell coming out
her budget
in 30 seconds time.
Disinflationary as possible. Then in turn, Bailey will be able can see through this and will be able to cut rates in December, or at very least tiered up very clearly and keep to this quarterly cadence, which they seem to like. I think that would be
everything they're saying here applies to the US as well. They're very similar situations.
Whether or not they cut.
Okay. Well, great to get your insights, both of you. Bloomberg's Lucy Meakin and Marcus Ashworth of Bloomberg Opinion. We can go now to the press conference. The Bank of England Governor, Andrew Bailey, has just sat down. He'll be speaking to us in just a moment. Marcus is going to be staying with us, but we can tune in and listen to what the Governor has to say.
Well, thank you, Katie. Today we're presenting a new and improved package of communication reflecting the progress that we've made in response to the Bernanke review. In our minutes, the monetary policy summary is shorter and more focused, while individual paragraphs set out the views of individual members of the Monetary Policy Committee. In the Monetary Policy Report, a monetary policy overview sets out the main economic narrative underpinning our decision, and then we have a range of boxes which present the key pieces of analysis that have informed that decision. And the report now presents detailed scenarios with illustrative monetary policy responses in addition to the central projection. Taken together, the new report and minutes are designed to allow us to adapt and respond.
Let's talk about their new way of doing minutes.
Putting greater weight on the key judgments behind our decisions, emphasising the underlying economics as much as the precise numbers, drawing on a wider range of analysis and framing our discussions within a broader range of risks. So this is a milestone in the response to the Bernanke review, and one that is testament to the hard work and dedication of the excellent staff that do all the hard work. It is, however, today a moment of great sadness for us. During the preparations for the November meetings, we lost a much-loved and respected colleague, Pavandeep Dharmi. Pavandeep was a mainstay of supporting the MPC for a very long time. His insight and his commitment helped shape the documents that we've published today. And so we've dedicated this edition of the Monetary Policy Report to Pav. The new material presents more information about individual views on the committee, but I should say at the outset that we're here today at the press conference to speak to the collective decision made by the MPC, not the individual paragraphs. So on to the substance. Today we've held bank rate at 4%. The start of monetary policy has supported disinflation over past nearly 3 years
FTSE 100
now.
Chart is on the...
And that progress has allowed us to cut bank rate 5 times, gradually making monetary policy less restrictive, while still seeking to ensure that inflation falls back to our 2% target and stays there. Headline inflation was 3.8% in August and in September, partly reflecting developments in food and administered prices. We expect this to be the peak. Beneath the headline numbers, underlying price and wage pressures have continued to ease. We expect headline inflation to fall to close to 3% by early next year before gradually returning to the 2% target over the subsequent year. But risks to disinflation remain, and we need to wait and see that the downward path of inflation becomes more established before we can cut our bank rate again. So where monetary policy goes from here depends on how 2 big forces play out. On the one hand, inflation is still well above the 2% target. It is possible that it could be sticky. For example, if increases in administered prices were repeated or if labour cost pressures continued to be elevated. There is a risk that the inflationary shocks we have had could have affected inflation expectations and the way wages and prices are determined in the economy. That could lead to more inflationary pressure. A scenario in the report illustrates that the path of bank rate might have to be
Thanks for the
higher
newsletter
than
comments, guys.
in response to that. On the other hand, activity in the economy is below its potential. We see this most clearly in the labour market, where the number of vacancies has fallen and employment growth has stalled. There is a risk that households and businesses remain cautious about spending and investment, holding back demand and weighing on job prospects further. And that could lead to inflation falling below our target. A scenario in the report illustrates that the path of bank rate might have to be lower than otherwise in response to that. Our monetary policy is being set to balance these risks in order to meet the 2% target sustainably, and so that bank rate is neither too low nor too high. So today's decision is based on two key judgments. The first key judgment is that underlying domestic price and wage pressures are continuing to ease. Recent data suggests that the risk from greater inflation persistence has become less pronounced, and the risk to medium-term inflation from weaker demand more apparent, such that overall risks are now more balanced. As the central projection in the report illustrates and is reflected in the market curve, this means that we are likely to continue to be on a gradual downward path for bank rate. Chart 1, which has just come up, shows 12-month inflation in the Consumer Price Index since 2021, that's the white line, along with its components, the coloured bars. The increase in inflation over the past year has been driven in large parts by the contributions from energy prices, that's the orange bars, which are no longer pulling inflation down, and higher food prices, that's the purple bars, as well as increases in a number of administrative prices that have held up the contributions from services prices, and they're in the yellow bars. The shaded area on the right-hand side shows how we expect headline inflation to ease again in the coming months as lower domestic cost growth passes through to lower services price inflation. And as we look beyond the next 6 months, the effect of past increases in administered prices should also drop out. Provided they are not repeated next year, that should shave off another 0.5 percentage point or so from services price inflation in the second quarter of next year. As chart 2 shows, disinflation in underlying services price inflation has continued. Although progress had slowed in recent months, high-frequency measures moved lower in September.
A bit more fancy than the US one.
Non-wage labour costs, including from the increase in national insurance contributions, to continue to limit declines in services price inflation in the next few months. But we expect progress to resume next year. And the decline in services price inflation is supported by a gradual normalisation of wage growth. As chart 3 shows, annual private sector pay growth slowed to 4.4% in the 3 months to August, that's the blue line, down from 4.9% in the 3 months to May, and below the projection in the August report. This recent slowdown is consistent with the signals from a range of other pay indicators. And we expect wage growth to ease further into next year. That's the blue diamonds on the right-hand side. There are signs that disinflation is on track. But that is not to say that the risk that the recent rise in prices could feed into more inflation through second-round effects has gone away. The recent pickup in inflation has been driven in part by food and energy prices. These are salient to consumers and often affect inflation expectations. So we have to remain careful that this does not lead to any additional second-round effects on wage and price setting in the UK economy. But while it is only one data point, it is encouraging that the peak in inflation in September was about 0.2 percentage points lower than we had expected in our August projections. Looking ahead, over the whole of our forecast period, as seen in chart 4 here, that's our November projection, which is conditional on the market-implied path for bank rate, this suggests that CPI inflation will fall to close to 3% early next year and then decline gradually towards the 2% target after that. Further disinflation is being underpinned by subdued economic growth. Some economic slack is needed to squeeze out the remaining stickiness of inflation. A looser labour market eases the pressure on wages, and moderate demand conditions combined with spare capacity within firms limits the scope for firms to pass on higher costs to prices. As disinflation progresses, however, there is a risk that activity cools too much or for too long. In our central projection, we expect growth to pick up gradually to solid quarterly growth rates of about 0.5% towards the end of the forecast period. As chart 5 shows, while consumption growth has remained subdued, real household disposable income has recovered. That's the orange line. That should support a recovery in consumption growth in coming quarters. But the pickup in growth may prove harder to achieve if consumers remain cautious about spending in the face of high uncertainty and a weakening labour market. And it has become clearer when I've been on the road with our agents in recent months that the labour market is slowing too. And we see this in the data too. As measured by the ratio of vacancies to unemployment, shown in chart 6 here, further slack has emerged. Not just through a reduction in unfilled job vacancies, as over the past year, but also through an increase in unemployment. So this takes me to the second key judgment, that if disinflation continues, bank rate is likely to continue on a gradual downward path. The restrictiveness of monetary policy has fallen as bank rate has been reduced. So the extent of further reductions will depend on the outlook for inflation.
That means
a
Rachel
gradual
Reeves.
approach allows us to assess the balance of risks to inflation, on the upside from more inflation persistence and on the downside from weaker activity, as the evidence evolves. As you can see from the vote today and from the committee members' new individual paragraphs in the minutes, making this assessment involves weighing the evidence on both sides. Different members have reached different conclusions on the balance of risks. Some members think something like the upside scenario is more likely than others, with the policy implications that come with that. Other members put more weight on something like the downside scenario, with implications for their views on policy. And with every cut in bank rate, how much further to go becomes a closer call. At this meeting, rather than cutting bank rate now, there was also an argument to wait and see that the downward path in inflation becomes more established. The latest data point on inflation was encouraging, but it was only one data point. Leading up to our December meeting, we will get more data on inflation and cost pressures in the economy to help us make the right decision. And we will be
Guys,
able
please
to
hit the like
analyse how
button
this
and
year's budget
subscribe.
might affect the economy and the outlook for inflation. As always, the MPC remains squarely focused on our remit to return inflation to our 2% target.
Line out of Jerome Powell's
I'll add a
book.
few words on quantitative tightening, as this is the first press conference since our decision in September to reduce the stock of government bond purchases held for monetary policy purposes by £70 billion over the year, from October this year to September next year. On the 11th of November, that's next week, the bank will publish its next quarterly assessment of transactions in the Asset Purchase Fund, where the bond purchases are held, along with a summary and projection of cash flows associated with quantitative easing and tightening under the indemnity to the bank. The upcoming APF quarterly report will include a new measure which will take into account wider implications for government debt issuance and servicing costs, including continuing savings resulting from quantitative easing. This will show a somewhat different picture on the costs. Looking ahead, the bank's policy is to meet the demand of the financial system for liquidity. Our approach is to transition to a demand-driven framework under which reserves will primarily be supplied by repo operations. This allows the bank to reduce the asset purchase facility in line with its monetary policy objectives and thereby reduce the exposures of the bank and the wider public sector to interest rate risk, whilst the bank provides the reserves through lending operations needed to maintain monetary and financial stability. This is important in supporting the operation of financial markets, including the gilt market, and in reducing the future exposure to interest rate risk. So with that, Claire, Dave and I will be happy to answer your questions.
Guys, if you want to win $2,000 worth of XRP, look at the pinned comment. Go and repost on X. If you have just tuned in, please hit the like button and subscribe. This is live. We're watching this so we can see what will happen, or give us an insight into what will happen at the next FOMC meeting. But here in the UK, this is also important. This is basically Jerome Powell of the UK, Governor Bailey. Let's go back to it. Hit the like button.
Sorry. Hello, Ed Conway from Sky News. As you mentioned, Governor, there's a budget coming up later this month, and everyone knows, and the Chancellor's kind of signalled that there is going to be some fiscal contraction. Obviously, we don't know what happens until the budget itself, but I just wonder, could you give us a sense of the extent to which that played a part? Just that the sense of this impending budget played any part in your decision, or indeed the decision of the committee?
Well, thanks, Ed. We only know one thing with certainty. That is that there will be a budget on the 26th of November. Well, actually, I'll tell you a second thing with certainty. That will be before the next meeting of the MPC. So we will have opportunity to consider the budget in the next round. As I'm sure you know, because we've said it many times, we condition our view of the economy and our projections on announced fiscal policy. So the projections that you've seen here and that are in the report are conditioned on the fiscal policy that was announced in March. It's not for us to speculate what's going to be in the budget. That's for the Chancellor to announce in the budget, and we'll then respond to it.
Martyn. Hi, Martyn Khan from The Times. Just to follow up, the Chancellor made quite an unusual decision to do a pre-budget speech, which actually was a lot about monetary policy. She kept repeating her insistence that she wants to help you out in the fight against inflation through her fiscal policy. Governor, given that you had the decisive vote, I'm interested in whether you didn't seem to have been convinced by her message, particularly given your assessment of the economy seems to be that actually the risk to inflation are a little bit less pressing, as you say in the report. And finally, the other message the Chancellor had is that everyone in the UK needs to be in it together. We all need to play our part. Does the Bank of England also need to play its part in the situation the economy and the public finances are facing?
Well, thanks, Martyn. I mean, in no sense are we passing any judgment on what the Chancellor said this week. As I've said, our very, very clear convention is that we condition our view on what's been announced. So we will do that. We have done that this time, and we will do that again next time. By the next time, there will be a new announcement. So we will have new fiscal policy to assess and condition our view of the economy on, and that's what we will do. So in no sense are we passing any judgment on what the Chancellor said this week. That should be very clear.
Sam and then Darshini, please.
Thanks, Sam from the FT. Governor, in your statement in the minutes, you allied yourself with a forward-looking Taylor rule and a similar market path, which points to 2 more cuts and things levelling out at 3.5%. Is it fair to say that, therefore, you now see 3.5% as a terminal rate for the bank? And could you give a sense of the debate and the range of views on the committee as to where the terminal rate would be? And just another follow-up on the budget. For you, again, personally, would it have been quite a closer call for you now in terms of cutting rates immediately if you didn't have the advantage of waiting until the budget had been held before and getting that on board before moving?
Well, let me take that question first, and I'll come back to the question on terminal rates. I think there's a very important point which I think you'll pick up not only in my paragraph, but actually other paragraphs, which is, and I mentioned it in my opening remarks, we've had one inflation number which came in under our projection. That's obviously very welcome. I think it does suggest, as I said in my comments earlier, that we've reached the peak. But my own view is, and I think colleagues share this in some measure, that of course we really do need to see more than one number to establish that is sort of in the picture, as it were. So I will be looking very carefully at, as I just said, at the data that we will get before the December meeting. That will be a very important consideration for me. So yes, we will have a new fiscal policy by that stage to condition on, but really importantly, we will also have more numbers And I'd emphasise that because we always have more new numbers, obviously. But the point is that we are at quite an important moment here because we've had one set of inflation numbers which I think can give us some encouragement, can point us in a direction, but we need to see more than that. Coming back, your question on first of all, I mean, I think all of us chose our words very carefully. For me, the market curve at the moment does give a reasonable view of of a sensible path. By the way, that's not always the case. I mean, sometimes we've sat in this room and not been quite at that place, so we can't guarantee you that'll always be our view. On the terminal rate question, I think it's probably quite clear also from comments, not only in this set of minutes, but in other comments the committee, as members of the committee have made in speeches they've made. I mean, we do divide somewhat into two camps. I don't want to overdraw it. There are those who I think who do take a view that, they do take a view on R-star and on the so-called, if you call that the terminal rates. There are those, and I'm in this group, who don't actually, frankly, feel that there is enough confidence around any measure of an equilibrium terminal rate, and that when we look at this question of restrictiveness, we're looking much more at the evidence on the sort of the change over time, as it were, in the path of restrictiveness, rather than looking at the terminal rate. But anyway, Claire may...
Yeah, I mean, happy to. We've set out quite a bit, actually, in the report in the risk sector. There's a chart 3.4 that shows you all the different ways that we look at this. I mean, our analysis is that policy is still restrictive. There's, as Andrew says, a difference of views. So much members have sort of raised this in their paragraphs about it. I mean, it's quite, determining how restrictive you are and issues around terminal rate, obviously quite complicated. It's quite challenging. It sort of gets more challenging as you lower rates, right? Yeah. So, we've sort of said that. But there's quite a lot of material in here that we've shown on this, and as Andrew says, the individual powers, I think, also give you a bit of a sense of how different people look at it. There is a difference of view, both about what the, debates and discussions around what the levels may be, but also around these more sort of philosophical questions about, actually, how do you know? How do you try and work it out? How important it is to you in thinking about your policy. And again, you can see that in the difference of views here, with it being a bigger issue for some people than for others.
The only thing I was going to add, because again, as part of what we've done today with, I'd agree with Andrew. This is a milestone in terms of responding to the Bernanke review. Is that we are trying to be as open as we can about, for example, the various risks. So one is this point about just how restrictive is the monetary policy stance. I mean, just to reinforce something Claire just said, one thing that we've added this time, as rather than just repeat the mantras about that there's a range of views on restrictiveness, is that some of us do put more weight than others on these quantitative estimates. But there is something in the minutes in para 12 where we say that, as bank rate approaches neutral, the contribution of monetary policy to underlying disinflation would become harder to discern, making the case for further policy easing more finely balanced. So this notion that, because we've been able to reduce the degree of restrictiveness, we would all agree that we're getting closer to the neutral rate or the terminal rate. So, that gives you some sense also that the debate and the way we're thinking about this is inevitably going to evolve and change in the future.
Darshini, and then Halia, please.
Thank you. Darshini David, BBC News. Another budget one, I'm afraid, but in terms of last year's budget, because the MPC have been increasingly clear in your reports in recent months about the role that measures such as the increase in national insurance, national living wage, have played in increasing price pressures and wage pressures. To what extent has that contributed to hesitancy over the last year when it comes to the cutting of interest rates? And if I may too, you've highlighted the risks in the stock markets in recent weeks and months. In particular when it comes to AI stocks. Now, those concerns have gathered pace somewhat over the last few weeks. Can you give us an update on your thinking there?
Sure. I'll repeat something I know I've said before, but I think it's important and I can sort of update it a little bit. Of course, for us, the big question was how would the change in national insurance contributions pass through, what was going to be the transmission of it. It's something we spend a lot of time on. I mean, when I go around the country, I'm afraid it's the first question that businesses get from me usually, which is, can you explain to me how you've responded to it? And we've set out in the past that there are a number of channels working through sort of margins, employment, wage settlements, investment to improve productivity. That takes rather longer, and obviously prices. I think I've said before, in the early days, obviously, and they're not mutually exclusive, by the way, there was a sort of tendency to tick all boxes. I think over time, I would say that the two labour market stories have probably come a bit more to the front of the responses we get. So I say, people who are not, employment has reduced. Now, by the way, I think that comes more through not hiring than. We're not seeing much of a pickup in redundancy measures, for instance, but I think it comes more through the channel of not hiring. And I think some others then say, well, actually, no, our wage settlement was lower than it would otherwise have been. That, by the way, is also affected by the interaction with the national living wage, because if you've got more people around the national living wage, that channel is not as open as it would be if you haven't. So that's a relevant consideration. So I think we've picked up some more of that, as I would certainly say so. On the stock market AI question, I just say one thing about this. I mean, it obviously is something that we look at very carefully, and you'll be hearing, but we're going to do it. The next thing we'll produce is the next financial policy report. So, you'll be hearing more about that on the financial stability report. But one thing I would say is this, because I think I've read a number of articles that have questioned this. It is, of course, perfectly possible and perfectly consistent that AI could be the next big mover in terms of productivity. So it could be the next general purpose technology. My own view personally is I think, more likely than not it probably is, but we've still got quite a way to go to actually sort of see that demonstrated. At the same time, we could have a bubble, because obviously the markets are pricing the future stream of returns from this, and that's uncertain. And so, those two things are not inconsistent. The markets could overprice the returns, but the returns could still be substantial. So we'll see. But we are watching obviously the implications for financial stability, and then the
This is the FOMC of the UK. If you've just tuned in, Governor Bailey, hit the like button and subscribe.
Monetary policy report. We, of course, will watch that very carefully.
This is our version of Jerome Powell.
Reinforce that point on the reason we've also flagged this risk in the monetary policy report is because were that bubble to deflate or burst,
this is the FTSE
that
100.
would represent a tightening in financial conditions, that would weaken global demand, and that would have spillovers back to the UK. So it is relevant to us on the MPC as well as the FPC.
Helia, in the middle there, and then Phil Aldrich. No.
Helia Ibrahimi, Channel 4 News. You haven't cut interest rates today, and clearly, Governor, you are the deciding factor. How do you explain wait and see to families at home who are struggling with mortgages and loans if you say inflation has passed its peak?
Well, I want to see more evidence that it's passed its peak. I hope it, I believe it has, but frankly, as I said before, in response to the earlier question, we've only seen one number so far. So I want to see more evidence. That's why, I've made very clear, you can see it in quite a bit of the commentary, including my own paragraph, that this is an important factor. Now, I think, I think the best way I can put it is, I think these two big risks that I was talking about earlier have, in my view, become more balanced since we were last sitting here in August. I think that's the way to put it. But the best thing we can do for families, as you say, is get inflation back to the 2% target. That's not only the best thing we can do, it's the thing we must do. And therefore, I'm encouraged that we've seen this one number, but I do want to see more of it.
And inflation is at 3.8%.
Yeah.
So, that's a long way above the target. We're back to 2%, and that's conditioned on the market curve. But 3.8 is quite a long way above 2.
We'll go to Phil here and then Joel at the back.
Thank you. It's Phil Aldrich at Bloomberg. There were two scenarios in the report today. I just wondered why one of those scenarios wasn't a fiscal scenario, given that the most immediate issue on the horizon is the budget, which it seems very clear that there's going to be consolidation at that point, and what that might mean for your reaction function. And just on, you mentioned regulated prices. The Chancellor is looking at, or supposedly looking at regulated prices. If she took action on that, would you welcome it?
I'll get Claire to come in on the scenario. Just on your points about regulated prices, can I go back to something, it's a totally fair question, Phil. Can I go back to something I said in my opening remarks? I mean, the important thing, of course, is what we see in terms of regulated price increases next year. Because obviously, sorry to state the blindingly obvious, but inflation is an annual calculation. So, we have these things called base effects where the effects drop out. The question, of course, is what comes next, and that will be very important. And I think that is a point that has been, taken by the government. I think you can see this from some of the things they've said. And I think if you go back to the point I think Darshini was making about what the Chancellor has said, I do think that it is a point the government has taken about the impact that these things can have on inflation and therefore on policy setting, and that's important. I'll hand over to Claire on the scenarios.
Yeah, and actually just on that, you can see the impact at the moment, the 3.8 number we're talking about. We think about 0.4 of that is these sorts of administered prices at the moment. I mean, on the scenarios, we've chosen these quite clearly based on the fact that they are the biggest issues in thinking about inflation and setting monetary policy to get it back to the 2% target. So, there is this question about how do we think about this balance across the economy of the risk that inflation proves to be more persistent for various reasons, whether that's structural change because it's been higher for a longer period, could be all sorts of issues. So that's one scenario that we have to think about and take very seriously and explore. On the other side, there is this sort of weaker demand scenario, which could come, potentially through the labour market or could come through what we're seeing in consumption, where, again, we've seen consumption being weaker than we've expected for quite a period of time. So we've selected the scenarios based on the fact that they are the most relevant things for the policy committee in thinking about inflation. And as you can see from the way in which different members have set that out, that framework is one that everyone's sort of consistently using and puts different balances on those two sort of forces, as Andrew described them, in terms of what's driving inflation.
Do either of those reflect the potential fiscal outlook from the budget?
So what we've done on the assumptions we raise, as Andrew said, what we do is we condition all of our work on the announced fiscal policy as it stands now. So that's the fiscal stance that was set out at the last budget.
Joel and then Philip.
Joel Hills, ITV.
Bank of England officials there speaking following the central bank's decision. You heard them under scrutiny from our very own colleague Phil Aldrich. And if you'd like to keep watching that news conference, you can head to Live Go on your Bloomberg terminal and you can follow along with all the latest news and analysis at TLIV Go. If you're just tuning in, recapping the decision so far, it is a hold at 4%, as most economists expected, so breaking with this cadence of quarterly cuts that the Bank of England did start last August. Of course, we've got a budget coming on November the 26th. We've got inflation at 3.8% here in the UK. But here, they've teed up a December cut, it would seem. It's a tighter vote split than had been forecast. The expectation was for 6-3. In fact, we got 5-4. Sarah Breeden, Swati Dhingra, Alan Taylor and Dave Ramsden vote.
Wage bargaining going forwards. And that's why we put a lot of emphasis, as I've mentioned earlier, on the question of inflation expectations and how those pass through. Now, obviously inflation has come down substantially from where it was 3 years ago, and we've seen wage settlements adjust down over time. But the emphasis that we've put in almost every report since then on the question of persistence is all about the question of to what extent there will be, continuing effects, this potential effect working through things like in expectations. So we will continue to look at it very carefully. What I would say is that we have been through a period where pay settlements were well above the level that all of our models were suggesting they would be. I think that may well be related to some evidence that we've had, over that period of time, a negative shock in terms of labour supply. There's a lot of questions about how we measure it at the moment and the uncertainty around the data. What I would say is the evidence, pay settlements are coming down. We seem to be likely to hit towards the end of this year around about the level that our agents in the survey they did at the beginning of this year sort of thought they would be. So they do seem to be tracking downwards, but that will, and where they go, henceforth will obviously continue as always to be an important part of our considerations.
Yeah, let me pick up, because that isn't quite what I said. What I did was I set out a set of basically ready reckoners on what sort of level of wages would be consistent with the inflation target, depending on what you assume about productivity and what you assume about import prices. Actually, most of those estimates were higher than 3%. I mean, wage growth is obviously something that we look at really carefully. It's 4.4% at the moment. That is higher than a target consistent number. We expect it to be coming down. It's one of the bits of evidence that we're going to be looking at very closely. I mean, as it is in our
This is
forecast,
the interest rate decision. Someone says you don't know what you're talking about. This is the Bank of England talking about the interest rate decision to hold.
It depends on what you assume about all these different variables, and that's what I was talking through, just actually how do these ready reckoners work, and what do you think about import prices and productivity and how that affects.
And what do you assume currently? What's a sustainable rate of pay growth?
Well, as I say, in the forecast that we have at the moment, towards the end of the forecast, it comes down to 3%, and that is where we also have inflation at 2% at that point. But as I say, that depends on a number of assumptions that are underpinning that forecast. And of course, we have some different scenarios that we've also looked at. So it's a good example of why, you want to look at a whole range of things. We have quite a lot of discussion of this in the report. Because it's important to us in terms of these underlying drivers of inflation.
And it's worth saying that a key underlying assumption that means that 3%, which is what we're forecasting for Q2 2027, would be consistent also with inflation returning to our target, is that there will be some productivity growth, around about, I think, probably moving up towards 1% or so. But that's the, that's how you can kind of make those two things consistent. But there's uncertainty around productivity, and it is absolutely critical that there should be some productivity growth.
There's also uncertainty about import inflation at the moment as well. So it's not as straightforward as you might hope.
Philip, and then Sue.
Hi, Philip Inman from The Guardian. I wanted to take a slightly different tack, which is to look forward to next year when you have a forecast for growth slowing, you have unemployment rising, and yet wouldn't it be reasonable for the public to think that you were more accommodative than you are planning to be? You still have restrictive interest rates next year when the economy is quite clearly suffering under your scenario before it recovers in 27 and 28. Why do you still hold that? Wouldn't the public think that it's reasonable for you to cut rates faster in that scenario?
Well, in terms of judging the restrictiveness of policy, I think it comes back to the answer I gave to Sam's question earlier, actually, which is, as we look forwards, this question about how restrictive policy will be at any given point in time. In my read of it, I always say, look, it depends on how the change in monetary conditions evolves. I don't have a view on the terminal rate. I don't fall into that school, frankly, because as I said earlier, I think just to be technical for a moment, the standard errors around those two estimates are just too big. So what that means in practice is that every time we meet, we have to rejudge this question in the sense as to how restrictive is policy, and that's got quite interesting over time. I mean, I'd give you the most obvious element of this question, which is mortgages, because the mortgage market in this country has changed fundamentally in the last 15 years. It's gone from being a variable rate market to a fixed rate market. That means that actually the transmission of monetary policy takes longer, comes through more slowly, comes through in parts, because obviously it depends on the balance of the mortgages that people have. And so we have to keep coming back to this question as well, and this is the point I think Dave was making, into financial market conditions. and rejudging this restrictiveness question. And as I think you can tell from the individual paragraphs, there are different views on the committee about just how restrictive policy is at the moment. So some of my colleagues, would I think push back at you and say they don't think policy is particularly restrictive at the moment. I think that it is still restrictive, but as we said, as Claire was saying earlier, and I would agree, the degree of restriction is reducing, which sort of is consistent with cutting, obviously, and we will have to judge that question going forwards about how restrictive it continues to be meeting by meeting.
Can I add a point on growth, which I think is quite important, which is from an inflation perspective, it depends what's driving the weak growth that really matters, and you can't necessarily assume that because growth is a bit weaker, and actually, we do have growth sort of strengthening through the period in our, it's, it rises a little bit towards the end, but it's really important to think that, depends what's driving the weak growth and whether that is about the level of demand in the economy or the level of supply, and that has very different impacts for inflation. So it's one of the ways we have to sort of think about this. You can't necessarily assume that weakness in activity is going to necessarily reduce inflationary pressure.
That's right. I mean, I've said in a number of speeches I've given recently that I think the biggest challenge we have in this country, and by the way, we're not alone. I mean, we're in company here, is that the potential growth rate has fallen over the last 15 to 20 years.
Sue and then John Paul.
Hi, Sue Chan at The Telegraph. Just following up on questions from Darshini and I think Phil, just stepping back a bit and looking at the last year, would you say government policy on things like the minimum wage, the national insurance increase, packaging taxes have helped or hindered your fight against inflation? And in general, are government interventions to bear down on prices welcome, or should policymakers stick to their knitting to allow you to stick to yours?
Well, it's interesting. I think we first, in a sense, drew attention to what we tend to call this hump in inflation in the February inflation report, so 9 months ago, I'm talking about. And actually, when we look back at the February monetary policy report and sort of the shape of that hump, it's a point Dave's made to me a number of times, he's nodding, it looks actually rather like it does today. We've had a few changes in between in what we thought might happen, but it's actually looks right. And one of the reasons is that, as Claire was saying earlier, part of that is these so-called administered prices. Now, they do have an impact, and so it is something that we've drawn attention to. And I think the second thing is that the pass-through of national insurance has not been that different to what we were expecting at the time. So those two things have more or less transmitted. Now, in terms of, it's for government to decide its own policies, because government has all sorts of other public policy objectives. I mean, we're one public policy objective, and I use public policy broadly there, obviously, as a term. And there are many other public policy objectives. So give you an example, in the administered price regime, part of that is water bills. Well, fixing the water system is a public policy objective. It's not Bank of England's public policy objective, but it would not be for the Bank of England to go around saying no attention should be paid to fixing the water system. That would not be, I think, a very sensible thing. So we have to take account of these. I think we do have to draw attention to the effects of these, which we do, obviously, and then factor them into our outlook.
John Paul and then Anna.
Hello, John Paul Ford-Rojas from the Daily Mail. A couple of things, please.
Please do hit the like button and subscribe.
The acoustics in here are sometimes quite variable depending on where you're sitting. If you could talk a little bit, it would be really helpful.
Yes, sorry. John Paul Ford-Rojas from the Daily Mail. A couple of things, please. First of all, households are worried about income tax going up, perhaps in the order of tens of billions of pounds. How much relief or reassurance can you give them that were that to happen in the order of that, all else being equal, that would provide an impulse to the bank to cut interest rates in December? Secondly, with your regulatory hat on, with car finance and the compensation scheme that's currently proposed by the FCA, you're the regulator also for banks. Banks are suggesting it would be disastrous and damage the economy. The FCA pushing back on that. Do you have a view on that issue, please?
Well, the income tax question, I'm afraid I'm going to give the same answer. It's really, of course, it's obviously for the government to decide what the budget's going to be. The Chancellor will announce it, and we will take it into account. The economic modelling for the budget, of course, is done by the OBR, not by us, and that's important. So we will assess what is announced by the Chancellor in our next round, and that's the right way to do it. So we're not giving a message on fiscal policy today because we'll wait and see what fiscal policy is. On car finance, look, when we do the next event in here, it will be, as I said earlier, the financial stability report. We will also be publishing the bank stress test. I think I'm right in saying that. Yeah, we will. And so we will obviously
FTSE is now going up.
Consideration for that. So you can look forward to that. I think it's next month, early next month. Don't hold your breath though for all the month long. I wouldn't advise that. Literally, that is.
Anna and then Ryan.
Hi, Anna Wise from Press Association. You say you're concerned about the high level of household saving. Can you explain what's driving this? Is it a long-term shift in behaviour, and how much are you having to take that into account?
Yeah, I'll get Claire to come in. Of course, when we say concerned, I mean, it is what it is. We're very interested to assess. Your question's a very good one, actually, as to why it is, because that's relevant to our outlook.
Yeah, sure, happy to. And as Andrew says, when we say we're concerned about it, it's one of the factors that is feeding through in our judgment on the level of demand in the economy, and therefore inflation. Obviously, it's for households to choose how they want to behave. I mean, in terms of, we've spent quite a lot of time looking into this because consumption is such a big part of the UK economy that it's a really important driver of what we expect to happen. And in fact, we've got quite a detailed box on this in the report. It's unclear. We've done a huge amount of sort of investigating into it. So some things are quite obvious, right? So interest rates are higher. That obviously incentivises savings, and that drives some of the behaviour. There may be some sort of what we call precautionary motives. And if you ask households why they're saving more, they do point to those sorts of things, not necessarily around the labour market, but in general more a response to sort of uncertainty and risks. The other thing that we've had a bit of a look at is this question of, are people trying to sort of rebuild their wealth following some shocks? So it could be a combination of things. We've looked at it in quite a lot of detail. It is one of the big drivers, and you see it come out in what a lot of members saying about the risks as they see around the economy. So it's something that we're really focused on. As I say, consumption being over 60% of the economy, it's a big driver of demand.
And just to add to that, we've actually tried to quantify in the downside scenario what would happen if savings doesn't fall back, which is what we've got in our central projection. For, as Claire was saying, those precautionary reasons. So if you think about the mechanism is savings staying higher, and then we've quantified the impact of that on consumption and GDP. So again, we're trying to sort of not just describe the risks, but also give a sense of what that alternative future might be with the downside scenario, which some members put more weight on than others then in how they vote.
Ryan, who's just there, and then Ritika right behind him.
Thank you. Ryan Saby from The Sun. What's your message to households when it comes to food inflation, especially with global and domestic cost increases, sees that those prices remain elevated? How can you explain that outlook for the next year, 18 months or so?
Well, again, I think in this story that, we've had this hump in inflation over the course of this year. Food is another, as we set out, another component of that. It's about another 0.4, isn't it? I think, something like that. And we thought, and I think we said this probably last time, that probably the peak would be around about sort of the later part of this year. Again, tentatively that looks like it is the case, which is obviously good and helpful. The components of that, as we said before, a bit of a mixture. So there's an element of global commodity prices. It's not spread across the board. It's quite concentrated in a few commodities. Coffee is one of them, for instance. There's some labour costs, undoubtedly. in there. And our contacts do mention the packaging tax as well. That's another element of it. So there's several components of it. The other thing, and I think I mentioned this earlier in my remarks, interestingly, our staff has actually given us some interesting analysis on this. There's a lot of analysis that says food is particularly salient in the inflation basket for the obvious reason that, in a sense, we all buy it very frequently. I was going to say every week or whenever, but I mean very frequently. So we tend to sort of, in our mental map, we can carry around the cost of food more than, say, a flat screen TV, which, well, I only speak for myself, I don't buy very often. It is salient. Now, so therefore, there's a sort of, there's a reasonably well-established view that actually, therefore, in terms of forming inflation expectations, these things will weigh more heavily. Our staff have actually presented some interesting analysis to us suggesting that may not be the case. So, jury's out a bit on that one. But look, it's really, obviously, to your question, really good question, it's really important, obviously, for people, because food is such an important part of the consumption basket. And can I say more so, because for those on lower incomes, food and energy, of course, are an even bigger part because they're the essentials of life. It is important that food inflation comes down.
Ritika, just there, and then Maurizio.
Ritika Gupta, CNBC. Governor, given the MPC sees a slack opening up in the economy, you've outlined weakening demand or weakening labour market. Do you ultimately think that interest rates are going to have to go below neutral in order to close a negative output gap?
Well, I'll bring clarity. I think there's two parts to this I'd emphasise. One is, what is the level of slack? The second is, how does that any given level of slack influence wage and price formation? It tends to be called the Phillips curve relationship, as we tend to call it. And those two things are both highly relevant. I don't know what you want to...
Yeah, I mean, sort of not necessarily is the point. I mean, look, to come back to this point that we have inflation at the moment that is 3.8, is higher than it should be, and it's, we're quite far from a target consistent level. So the slack is unfortunately needed to bring inflation back to target. It's not necessarily needed. It doesn't necessarily mean that interest rates have to go below the neutral level, because we think we have some now. It's a very uncertain. It's a very sort of hard thing to judge, and we spent a lot of time thinking about it. But we do think there's slack in the economy now, and that will sort of widen slightly.
Maurizio and then Joel at the back.
Hi, Maurizio Allen-Carr from Citi. Just wonder, with this decision today and the minutes in your report, what message you're sending to markets and to business confidence? Is holding interest rates going to weigh down on business confidence, given expectations of fiscal restraint at the budget and a lot of other sort of geopolitical uncertainty at the moment? Thanks.
Well, can I? Yeah, it's a really good point. So let's try and boil it down a bit. We talked about sort of two sort of risks that we have. One is that higher inflation becomes embedded more, and the other one on the other side is, going back to the previous question actually, is that we get this weaker demand story coming through. Going back to the earlier question, that as Dave was saying, that consumption doesn't correct, saving rate doesn't correct. And those two things, are what we're sort of steering between. Now, I think those two risks have become more balanced than when we were sitting here. They were, in my assessment, when we were sitting here in August the last time we were sitting here. I do think we're now in a more balanced position. And I just use again the phrase that I used in my opening remarks. I think rates are on a gradual downward path. But the judgment about when and by how much is going to be very conditioned by how we see this balance of forces going on.
Joel at the back.
Thank you. Joel Suss, Financial Times. I want to just come back to the terminal rates. So in this NPR, you've added simple policy rules as a way to illustrate how bank rates should evolve under the central projection in different scenarios. But of course, the simple policy rules require an estimate of the neutral rate, which you've set as 3%. So I just wonder how we should read that, especially in relation to the market rate of 3.5%, your own stated position of 3.5% seeming right at this point in time. Is 3% the default or average view of the committee? Should the committee be plugging in different estimates of the neutral rate? Thank you.
There isn't an average view because, as I said earlier, some members put more weight on estimating a terminal rate than others.
Yeah, look, let me pick this up. I mean, really pleased that that people have sort of spotted this policy rules material. I think it's a good innovation, and it's something where we're trying to be a bit more transparent about the sorts of information that we look at as a committee. I wouldn't take from it anything about, we're giving any sort of steer or indication about neutral rates. There's a very lively debate across the committee on this. What these rules are really useful for is helping you think through, how you think about policy looking forward. What are the things that drive you? In some cases, you might think some rules are, more appropriate if, for example, you think that the forecast at 12, 18 months is a pretty, is a good indication. You might put a bit more weight on the forward-looking rules. If you think actually some of these equilibrium variables are a bit more uncertain, you might be more interested in your first difference. So the idea really is we're showing you the sorts of things that we look at because they're part of the debate that we have. We're not trying to either directly or indirectly send any signal about this much broader question of neutral rates, where we also discuss that very directly in the report when we look at all the different ways you can look at it and what that might be.
The only thing I'd add is that, we obviously, this is an issue we faced in the way we've, I think, quite rightly taken the report. Obviously, with the central projection, we condition on the market path. Once we introduce scenarios, if we condition the scenarios on the market path, we'd be really suffering an apples and oranges problem. You'd rightly say to us, hang on a minute, that doesn't really work. So we face, well, what are we going to condition on? And I think using rules in the way we have, not using a rule, as Claire said, but more than one, but not too many, is the sensible way to do that. Not because we follow them, but because they're sensible sort of conditioning assumptions, and they give you a sense as to how we think about them.
Michael, and then Delphine.
Michael Race, BBC News. Regarding concerns about food costs and consumer spending habits and overall consumer sentiment, rather, how concerned are you that the public is somewhat scarred by the inflation shocks that have gone in recent years, and what impact do you think that's going to have in the coming months, years?
Well, it's a very important consideration. It's lain behind a lot of the thinking we've done on this question about persistence of inflation, that would the public feel, well, once it's in the system, it will stay in the system. Actually, I would say the big inflation we had 3 years ago, the numbers came down quite rapidly. That didn't surprise me because, a lot of those shocks were very specific shocks to do with COVID supply chains and to do with Ukraine, for instance, impact on energy prices and food prices again. But it is a very important consideration for us because it comes back to this point about how expectations are formed, what the influence is. And that's very important for us because, of course, it's a very important factor in shaping how we set policy because we have to respond to that.
In fact, I would just add on that. Inflation was very high. It was very difficult for people. You would expect that, therefore, to have changed the way people think about their own finances, the economy, and we have to think about that in terms of what will that mean for how behaviour may or may not change. And so, always when you have a shock that's quite far outside, what you're used to, it can change some of those relationships. And so that's one of the things we really have to think about what will happen for inflation in the economy going forward and how best do we sort of understand that. And again, that's why some of the scenarios and some of the things that we've presented here try to get into some of those questions.
Reading the agents report, it's quite clear sentiment is very flat. Are you generally thinking that this is going to have an impact over a sustained period?
FTSE climbing to the highs of the day.
I would come in on that as well because we are still having to deal with the consequences of all these shocks and that over recent years, and so this scarring can both be in terms of perceptions of inflation, but to your point about activity being flat as the agents have described it, we also talk in the box on consumption that Claire was referring to earlier about the potential scarring effects on consumption from the high inflation, that it may lead to a more precautionary approach. So, these kind of complexities are playing out across different parts of the economy.
Go ahead, Delphine, and then last one from Francine.
Thanks. We've had lots of talk from policymakers over the last couple of years about a crisis of economic inactivity and joblessness. And it was interesting to see in your analysis that you think participation is actually pretty much bang in line with what you were expecting before the pandemic. Is that because things have improved recently, or was there a massive misdiagnosis?
Well, there are levels of uncertainty and levels of uncertainty. I think the uncertainty in this area is very high. I mean, I think you can see from what we've published, you've got two different official measures, which actually give you very different paths of how this thing has evolved. So I have to be honest with you, I mean, I'm sorry to speak for myself now, for my own judgments, I am reserving a lot of judgment on this question as to where it actually is at. It's we've said before, it's the hardest thing to measure. It is. I mean, it's harder to measure than many other bits of the labour market. So given that uncertainty, given the fact that I say we've got two official measures which do tell different stories about the path, I'm certainly reserving judgment on this question.
I mean, not least because the improvement has happened very recently.
Yes.
So we've kind of got back to that pre-COVID level in the latest data, and it seems to be more apparent amongst female participation than amongst men. So you can tell stories that explain it, but it is a very recent development, hence why Andrew and the rest of us to varying degrees are saying, well, look, this is the participation puzzle may be starting to resolve itself, but we need more evidence.
Last one, Francine.
Thank you so much, Francine from Bloomberg. Governor, how do you think the neutral rate has actually evolved over the last decade?
Well, having said, of course, that I don't have a neutral rate about it, I think that's a slightly different question. So I think that if you look at the long-run neutral rate, then it's influenced by much more sort of big global factors. And the things that influence that are, one, the aging population, because we all save more as we get older. That's the sort of life cycle hypothesis. And so if you have a population that is on average aging, that will probably increase the stock of saving relative to investment. That would push the long-run neutral rate down. Now, if we get, of course, a pickup in investment demand, which you're probably seeing at the moment more in the US economy than you are in other economies, then that would correct that, if you like. So if you look at something like the AI investment boom in the US, then you'd say that might be something of a correcting factor. And so these are global trends somewhat, so that might go the other way. But that's the sort of framework. I mean, it's the saving investment balance, the impact of productivity change to the extent that's driven by innovation and investment that tend to be the longer run driving factors in those calculations.
I mean, it's probably fair if I can just add that we've talked about a range of estimates for the neutral rate between 2% and 4% before. Most analysis would suggest that to the points that Andrew's making, plus if you add in, say, fiscal, you might say that the neutral rate has gone up a bit compared with 5 years ago. But that doesn't really help you at all with where it is in that range of 2 to 4%.
Thanks very much, everyone.
Thank you.
Okay, that was the Bank of England. Let me just bring you the analysis afterwards, and then I'll give you a chance to win $2,000. So wait 1 second. Let's look at the analysis. I'll give you my thoughts, and then a chance to win $2,000. Magic numbers I'll be giving you.
Breeden saying that she's now more confident disinflation is on track. And the governor, you heard him there, saying that the Monetary Policy Committee is broadly split on the question of the terminal rate. Now, the guidance has had a makeover. They say that rates are likely on a gradual downward path. Previously, you'll remember they said they were taking a gradual and careful approach to rate cuts. They say now the overall risks to inflation are more balanced, and they see inflation below their 2% target by the second quarter of 2027. And an interesting note as well from the governor on artificial intelligence. He says it could be the next big mover on productivity, but AI could be a bubble. So reiterating his cautious view on what he's previously described as stretched valuations and the implications for financial stability. Taking the temperature in these markets, the pound dropped on the decision, but it's pared those losses and then some, currently at a 130 handle, up 0.4%. The two-year yield at 3.78%. We are lower 2 basis points both on the 2-year and the 10 at the moment. And the FTSE 250 had been flat to the downside before the decision. Now it's up 0.1%. But we can get analysis now, more analysis, and I'm pleased to welcome former Bank of England Monetary Policy Committee member Martyn.
Okay, let's look at this, and then a chance to win $2,000
and Catherine
from an
Nice,
XRP
who spent
video.
nearly 22 years at the Bank of England and is now Deputy Head of Global Economics and Chief European Economist for PGIM. Lovely to have you both with us in the studio. Martyn, let me start with you. Was that a dovish hold?
Well, I would say it is a fairly dovish hold. It does give the impression that there is room for rates to fall. We had people saying they weren't sure about the inflationary pressures and so on, but on balance, I think it was a dovish hold. And of course, the fact that it was 5-4, only one person needs to change their mind in December.
And how would you have voted?
I'd have voted to cut.
Really? With inflation at 3.8% and a budget round the corner?
Yes, I thought that the deflationary or the easing in inflationary pressures has been quite marked. The slackening of the labour market has been quite marked. In other words, I was agreeing with the sort of general view expressed by the people who voted for a cut.
OK. Catherine, how would you have voted?
So we've got a little bit of a difference, I think, here. Maybe that's more interesting. So my take is actually it is quite a hawkish statement. That's my immediate reaction. Not so much because of the decision. So I was with most economists and I thought that they would hold. I think they're likely to cut in December. I still think that. But I was a bit surprised by the prominence of this discussion around restrictiveness and where is the end point. So to me, it seems that they are signaling that the end point could be, closer than we think. I certainly had a view that we would probably end up near 3% by the summer. And now they're sort of signaling, I think, some distance from that, particularly Andrew Bailey. So from my perspective, the immediate reaction is a bit more hawkish.
I just want to play back one of the lines from Andrew Bailey, the governor, in terms of the rate path ahead. Let's take a listen.
The extent of further reductions will depend on the outlook for inflation. A gradual approach allows us to assess the balance of risks to inflation, on the upside from more inflation persistence and on the downside from weaker activity, as the evidence evolves. And with every cut in bank rate, how much further to go becomes a closer call.
So the closer they get to neutral, the more carefully and slowly they want to move. Where for you is neutral, Catherine?
Well, I'm going to stick to my guns and say I still think that is probably some way south of the path that
Okay, well, we got a good insight of what the next FOMC will look like. Probably similar. Maybe they're going to hold, and then they say they want to look at some more data. Maybe they'll cut. We'll do a full analysis in the newsletter. Please do check out the newsletter. The link is in the description. Now we're going over to, because the video is just about to come out, it's pinned in the chat. This is everything you missed from the event yesterday. So it premieres in 2 minutes, and there's 3 magic numbers. We went live earlier, so I'm bringing it out as a video again. There's 3 magic numbers. Add them together, put it into the giveaway page, and that gives you tickets to win the $2,000 worth of XRP. Just to reiterate, we just had the Bank of England decision. It was a hold. They were 1 vote away from a cut, and they said they're waiting for they're probably waiting for the budget, and the budget is coming out on the 24th of November, so that's what we'll be covering. Inflation's coming out. They think it's peaked, and that's why they said that they're probably going to keep reducing rates until they hit their neutral rate. We'll analyze it more in the newsletter, but right now, in 2 minutes' time, we're going over to the next video, which is live on the show, so check it out. It will be 12 Ripple Swell 2025 in 15 minutes. So it's only 15 minutes. Watch it all the way through, and then you can add up those magic numbers and put it into the competition page. How did I see that video earlier? Oh, well, we were doing it live. So if you were with us like a couple hours before we normally go live, then you would have seen that live and you might have the numbers. You can go back and watch it, but most people missed it. So here is the link. Go there now. We're starting there. This will automatically take you there. Thank you, everyone, for tuning in. It was interesting to watch the UK's version of the FOMC. No questions here, I don't believe. Okay. Thank you, everyone, for tuning in. Go over to that video. It's starting now. Until next time, take care of yourselves and each other. Bye-bye.